As realtors, you meet new people all of the time. Over the years, you have met hundreds of people with all manner of facts and circumstances. Some of those people have real estate that you choose not to address. Multifamily, commercial, farms, and businesses are not in the wheelhouse of most realtors, so you tend to let the opportunity pass. This short presentation will teach you a couple of techniques that will open these markets for you anywhere in the country. We will use two examples of people, assets, and outcomes. You need to think about who you know who own assets that are income producing, wherever they are located. The first example is a couple, about 72 years old, that own 5 rental properties ranging from 3 to 5 units each. They are getting tired and want to reduce the management burden. They have 2 children that live nearby and they hoped would take over the properties. But the kids have no interest in it, a fact the father reminds us of regularly. They decided to sell off 2 properties and keep the easier ones. Like everyone, they wanted to increase their income, pay little in fees, and no taxes. No problem. We used 2 tax and legal tools to get this done. You are probably familiar with the 1031 exchange, selling and buying income property while continuing tax deferral. Less people are familiar with charitable remainder trusts, or CRTs. With a CRT, the clients transfer the property into the trust before they sell it. They receive income for life. Their charities get what remains. Because of this, they get a tax deduction for the value of what is scheduled to remain based on the client's age and the amount of income they plan to receive while alive. The client wanted to do a 1031 exchange into some type of passive investment. They hired a qualified intermediary and asked a broker they knew to find them a real estate investment trust, a REIT. The REIT would pay them 6%, and they said there was no fee to buy the investment. Rick from our office was familiar with that particular REIT and knew that there was a fee to purchase the asset, but you could adjust it. The broker was to be paid 6% to research and sell this asset. As independent financial fiduciaries of a registered investment advisor, we can help buy the REIT with a lower fee or no fee. In this case, we charged 2%, and it was paid via the REIT purchase. The 1031 exchange deferred taxes. The building sold for $740,040, and the client received $700,000 net. Because of what they paid for it and what they depreciated over the years, they were facing $175,000 in tax. If they invested the remaining $525,000 and earned 6%, their income would have been $21,383 after income tax. Because Rick helped with the REIT, the $700,000 bought $28,000 of additional value and increased the income from 6 to 6.25%. After-tax income is now $29,700. This adds a little over $8,300 per year indefinitely. The difference between the straight sale and the reduced fee REIT is 38%. The clients are happy. If you referred this client to a multifamily specialist, there should be over $5,000 in income available. The second building was gifted to and sold from a charitable trust, the CRT. Remember the process. Gift the asset to trust, sell it, and pay no income tax on sale. Depending on age and income, receive a sizable income tax deduction to be used against current and future income. Income from this trust is also tax preferred. Again, if they had sold the property netting $600,000 after fees, paid the taxes, and invested the proceeds, net annual income would have been $18,001. Using the CRT, net income is $31,800. This is a $13,800 annual increase in income. This is a 72% increase. That is massive. And there was over $4,000 of potential referral compensation. So this couple decided to do some planning while selling their assets. Their income increased by over $22,000 at over 50% of the non-planning options. They are happy, and $9,000 or more was available for a person referring the real estate transactions. There are a lot of people like this. Think about who you know. Our second client has unusual circumstances, but this case could be much smaller than this and still work. People who own substantial business assets, farms, often owned by more than one sibling, and this client can use some form of this or similar plans. This woman inherited a building in Silicon Valley. During the years that she owned it, the value had gone way up. She was very involved in managing the property. Her income, compared to the value, was not great. First, we created a 1031 exchange, identifying two properties to purchase, one in Indiana and one in Ohio. We shifted the debt from the California property to the Indiana property. A charitable trust cannot have an asset with debt, so now we were able to transfer the Ohio property to the CRT. The exchange before the gift increased our income from a net of $205,000 to $246,000. That is a 20% income increase while reducing her risk and effort. Making the gift to the CRT increases her net income to $488,000. That is an increase of over $280,000, over 136%, more than doubling. She is happy. Total commission on this larger project was $1,136,000. Some portion of that income is available to the referrer of the seller in one case and the buyer in two cases. If all done out of state and/or only the referral fee on one half of the transaction, the compensation available was $142,000. We do not expect you to know this well enough to present this information to people, just to know you have tools that can help them. We, of course, hope you introduce people to us, and we will introduce them to what is possible, and you to resources you may need. Please call Rick or Brooke at 952-224-9085 or email us at info@adamshansen.com.